Dakota today. Well, our ability to earn money and manage it impacts nearly every area of our lives. This October, we're focusing on how you can become smarter with your money by challenging all North Dakota residents to take the Smart with My Money Personality Challenge. You can learn how your personality affects your approach to money and how you can use those characteristics to improve your financial wellness. Joining us today is Thomas Beadle with the Bank of North Dakota. Good morning.
Good morning.
Well, we're so happy to have you back.
Yeah, thanks for having me.
Yes, we appreciate it. So let's kick things off about talking why simply saving for retirement is just not enough. And what are some of the common mistakes that people make even when they are actively saving?
Yeah, I mean, simply saving for retirement is first off, saving for retirement, doing it early, best thing you could do.
Yep.
Helping to start that off now is going to pay massive dividends for your life. That's something that we're working with Bank of North Dakota and the Smart with My Money initiative just to make people aware of it. We want you to plan. We want you to be prepared. But not every retirement product, not every vehicle is going to be the best for you. And so you might find yourself in a situation where things are changing in the policy you had signed up for or the company you had signed up for. They're making decisions that you don't like. They're not managing risk tolerance levels the way that you are. They're rolling the dice with your money. And so you need to make sure that you're keeping an eye on it so that you're prepared.
Yes, definitely. So how should one go about setting a realistic retirement savings target?
Yeah, so understanding where your situation is. What do you have for payments that you're going to have likely coming up? What do you owe for expenses like insurance and your house and your car? And what is your meal situation like? Do you go out to eat? Do you plan on traveling in retirement? Like, what are your expenses looking like?
Yep.
And then once you kind of figure out what those expenses are looking like, once you set that finish line for the race of where you think you need, then it's a matter of building up the assets so that you have earnings coming off of that so that you're able to cover your expenses. We don't want you to only have enough set aside that you can only enjoy 2 years of retirement.
Yep.
Make sure that you understand what that finish line is and understand what is it that I need to have in the bank and what do I need to have in my retirement accounts so that I can actually live the life that I want to in retirement.
Yeah, so let's talk a little bit about fees.
Yeah.
It can seem like a small percentage, but they can end up adding up. Right?
They can add up in a big way. Fortunately, there's a lot of new opportunities in the market, new vehicles in the market, ETFs that'll bring fees down to 0.03% on the money that you have in the fund. But there's a lot of them out there that are charging you 1%, 2%, 3% for your money. And there's some money managers out there that are charging you even more than that.
Yep.
Now they might be worth it. They might be getting you far more of a return than they're going to cost you, and that's fine. But understanding what are the fees and how much that takes away from you can be hugely impactful, because if you are getting an 8% return, that sounds pretty good.
Yeah.
I mean, that's more than inflation. That should be keeping up with expenses. But if you're getting 8% return and you've got 6% worth of fees in order to get that, well, now you're left with 2% growth on your money. And so is that really going to be benefiting you long term?
Yep.
And so keeping an understanding on what are all the fees that are a part of it, where are you being charged, and how you might be able to lower those could really help jumpstart your retirement savings.
Okay, interesting. So how does someone know if their portfolio is being kind of properly allocated?
So a lot of folks will jump into a life cycle fund. It might be one that says, okay, based off of your age, you're going to retire in 2060 or 2070. And so based off of those funds, they'll be set up, and those funds will kind of naturally adjust their asset allocation as time goes on. When you're younger, they usually say invest more in equities, buy stocks in Amazon and Tesla and Microsoft, what have you. Because those companies, their stock valuations, they might be more volatile. They might have a little bit more of a roller coaster, but historically they grow much faster than the bond market. As you get closer to retirement, look more towards those fixed incomes. You want to have a little more into those set, steady returns, bonds type investment vehicles, and so that you have that guaranteed income kind of coming in. They're a little less volatile, but they're going to be less growth potential historically for those. And so you want to kind of watch how your portfolio is allocated. You might be in a life cycle fund, or you're managing it yourself, and kind of watch where you're allocated based off of where your life is, because that'll kind of talk about what's your risk tolerance, what level of growth are you going to take, but at the same time, it's a roller coaster. What ups and downs are you willing to weather for that? And so your portfolio allocation pays a huge impact on that.
Okay, so let's say, you've been saving for retirement and then something comes up, you're tempted to dip into that savings fund. Tell me how people navigate that.
Yeah, that's a challenge. And so we always, try to caution folks and those that are in the business as professional money managers, always try to caution you, make sure you have a cash pile set aside so that you don't have to rely just on your retirement account day one. Have savings accounts, have some other stuff set up so that you can, have a little flexibility and wiggle room. Because think back historically. If you would have retired in December of 2008, that would have been right at the great financial crisis. I mean, you would have seen your stock, your portfolio go down rapidly over a couple of months. Now it's sprang back up within a few years, but if you had to draw it at that point, you're taking everything out at a low, you're taking out a loss. That could severely restrict your earning potential in your retirement. Or in COVID, we saw stocks plummet in 1 month and pop right back up the next. And so we want to make sure that you're kind of positioned so you have a little bit of cash, understand what your needs are, so that you can prepare yourself so that if the market takes a dip or life throws a curveball at you, you're prepared and you don't have to sell at a negative position or at a position that's going to really hurt yourself in the future.
Definitely. Well, we chatted about a lot of really important topics this morning, but you guys have a wealth of resources on your website. Do you want to share what that is? Yeah,
smartwithmymoney.indy.gov has all sorts of tips and tricks and tutorials on there. We're not there to replace a financial portfolio private sector investor, but help supplement and give you knowledge so that you can walk into those conversations, to know whether you need to withdraw 4% or 5% or what have you for your own portfolio. And so smartwithmymoney.indy.gov, all sorts of tips and tricks that are all free for all North Dakota citizens.
Well, wonderful. We'll be sure to check that out. Thank you so much for your time.
Thank you.
Yeah, we appreciate it. Everyone at home, stick around. More North Dakota Today coming up for you after the short break.